Welcome to the deep dive. Today we are tackling what looks like one of the most glaring disconnects in the entire market.
It's a big one.
We're talking about PayPal. The ticker is PYPL, and right now it's trading at about $63 a share.
Yeah, $62.81. But here's the kicker. When you run a pretty standard discounted cash flow analysis on it,
A DCF. Yeah.
the value it spits out is closer to $156.
Wow. That is an enormous gap.
Yep.
So that's our mission today. We're looking at a $64 billion giant that the market is pricing like it's in trouble.
Exactly. So where do we start?
Let's start with the basics. What is PayPal actually doing right now, and what's the good news the market seems to be completely ignoring?
Okay, so their money comes from two main lanes. First, you have the high volume stuff, the transaction revenue.
That's the PayPal checkout button we all see, Braintree.
Right. And it's all driven by this immense scale. Last year, they processed, $1.68 trillion in total payment volume? TPV.
Trillion. Okay. And the second lane.
That's the value-added services. Think buy now, pay later, credit products. And now they're even getting into things like PayPal ads.
And the recent news has been pretty good, hasn't it? I saw their Q3 results.
Very good. They beat on revenue, came in at $8.42 billion. EPS was strong, about $1.34. And they raised their guidance for the full year.
But the big one, for me, was the dividend. They announced their first ever dividend.
That's a huge signal of confidence. Management is basically telling investors the cash flow is real and it is durable.
And on the tech side, there was that OpenAI partnership.
Yeah, for the ChatGPT wallet integration. That's a step into what people are calling agentic commerce.
Okay, break that down, Source. Agentic commerce, in plain English.
It's essentially AI-driven payments. So imagine your AI agent, like ChatGPT, just handling a purchase for you in the background. You don't even have to log in. It's totally seamless.
So we've got record scale, better than expected financials, a new dividend, a cool AI partnership, yet the stock is valued so low.
Well, that's the puzzle, right? I mean, it's trading at a PE ratio of maybe 12 to 13 times earnings.
Which is incredibly modest for a fintech platform of this size.
It's like it's being priced like a slow-growth utility company, not a tech leader. The market is just deeply, deeply skeptical about its future growth.
And that skepticism is what creates that huge DCF gap we talked about. That 156 valuation assumes pretty reasonable growth, right?
Very reasonable. It assumes growth tapering from about 8% down to 4% over 5 years with an 8.5% discount rate. And they are generating the cash to back it up.
How much cash are we talking about?
Free cash flow last year was $6.77 billion. The money is there. The issue is that the valuation is incredibly sensitive to risk perception.
So wait, you're saying that whole $100 gap could just come down to how you calculate risk?
Pretty much. The market is clearly leaning toward fear. It's using a much higher discount rate.
How much higher?
Well, if you just bump that discount rate up from 8.5% to, say, 11%, just a 2.5-point jump,
Yeah.
the intrinsic value plummets. It drops by almost $50 down to about $108 a share.
Okay, so what are the risks that justify that level of fear?
There are three big ones. One, fierce competition. You've got Stripe, Adyen, Block, all chipping away. Two, regulatory challenges are always a threat. And three, and this is the most important one, execution risk.
Can they actually deliver on these new ideas?
Exactly. Can they really monetize Venmo? Can they turn that cool ChatGPT partnership into actual high-margin revenue?
So what we need to watch for in the next couple of quarters is all about execution.
It's all about the margins. We need to see a shift toward their higher-margin branded products. The dividend is a nice signal, but the market needs proof that this cash generation can actually accelerate.
So the bottom line is PayPal has this dominant scale. It has incredible free cash flow. It looks undervalued, but only if you believe in their ability to execute.
That's it. The market is just waiting. It needs proof that PayPal can turn its massive size into reliably higher profits. So the final question for you to think about is this. What single piece of data, what one metric, would be enough to finally convince the market to close that massive valuation gap?